According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey of supply managers in the Mid-America region, the 9 Mid-America regional states, stretching from North Dakota, Minnesota in the north to Oklahoma and Arkansas in the south, the overall reading was up briskly, up to 64.0 from January's solid 56.2. Of course, anything above 50 is really strong, is a good reading. We've got 50 being growth neutral. In terms of, we ask about challenges for the firm, more than 4 out of 10 of the supply managers rank supply disruptions. Of course, with what's going on in Ukraine now, we have to double that, I think. Big concerns. More than 1/3 indicated that finding and hiring qualified workers was their biggest challenge going forward for 2022. And approximately 17 to 18% named rising input prices. So those three factors are the biggest challenges moving forward for the supply managers. Our overall inflation gauge for the month was still indicating excessive inflationary pressures. Let me bring up the graph of the Creighton PMI, Purchasing Management Index, and that's in blue, compared to the U.S. number there in red. The U.S. number for the month of February will come out later on this month. And you can see the overall reading is a really strong, again, 64.0. You see over the last 18 months, the highest reading we recorded was 73.9.
What were the hiring trends?
The hiring index jumped higher, much higher. Still between 50 and 60. It's 56.6 for the month of February, and that's up from January's very weak 43.6. So the readings were still about 2% down for most of the states in terms of overall employment, down from the pre-pandemic levels. That would be February of 2020. We asked the supply managers about what they expect in terms of a raise for this year. How much of a change in pay do you expect this year? On average, about 3%. That's very, very, I would call it modest or even weak, given what's going on in terms of the overall demand for labor. Effectively, all states are at what I would call full employment. So what's happened, of course, is we've had a lot of individuals leaving the workforce, and that's the big issue in the region and the nation.
What inflation trends are you noticing?
Inflation gauge still is indicating excessive inflationary pressures. The overall index for the month of February declined to 80.5, and that's down from January's 87.5, which obviously is indicating excessive inflationary pressures. These readings, of course, range between 0 and 100, and 80.5 is a very strong reading. 68.3% of the supply managers indicated deliveries slowed from January. Imports and exports were very weak for February, so things are just looking like we're slowing down. Although the overall reading is still strong, we're seeing manufacturing in the region gearing up for February from January, but the indicators point to somewhat slower growth in the weeks and months ahead.
What is the economic outlook?
The inflation remains very high. I don't expect it to cool anytime soon, and the earliest would be Q3 of 2022. It'll depend on a lot what happens in Ukraine. We've got the Ukraine situation, the Russia invasion of Ukraine pushing up commodity prices overall, and that's really going to push up inflationary pressures. We're talking about economic growth, I think, will slow simply because of supply chain disruptions from what we're seeing in Russia. That has an impact, and it ripples throughout the world, and of course that ripples and is telegraphed back to this part of the country. So I expect economic growth to slow. Supply chain disruptions will continue and lengthen. Short-term interest rates will rise by at least 0.25%. The Federal Reserve meets on the 15th and 16th of March. I expect a rate hike, but it's going to be modest, 0.25%. I would have said 50 basis points or 0.5%. With the situation, Russia invading Ukraine, that's off the table. I think it's 0.25%. Long-term interest rates are beginning to rise, although now, again, with the invasion of Russia into Ukraine, what does that do? That means the world, the globe, investors globally are putting their money in the U.S., and that's a flow of funds into the U.S. That means long-term interest rates will come down probably. Supply chain shortages, we're talking about bottlenecks, labor shortages, inflation will be the chief impediments to growth. And on keep an eye, what investors and viewers need to keep an eye on is the yield on the 10-year Treasury. I'm sounding like a broken record on that one, but keep an eye on that. When it comes down, and I expect it to come down somewhat until we have some resolution in Ukraine. Also, keep an eye on the employment report, which comes out this Friday. The last one was very strong, 467,000 jobs nationally. That's not going to be that way this month. Look for, if a number breaks below 100,000, that would be concerned. Anything between 100 and 300,000 is going to be okay. Keep an eye on the price of the barrel of oil. We're now getting close to $100 a barrel, between 90 and 100. Breaking above that would push, of course, inflation expectations higher, and inflation for that matter. So keep an eye on that number. And of course, listen carefully. Listen carefully to what the members of the FOMC, that's the Federal Open Market Committee, what the Federal Reserve's Open Market Committee, they're meeting again on the 15th and 16th. But in advance of that, they'll be telegraphing to us what they intend to do on that day. That would be the 15th and the 16th. They'll announce it on the 16th. I don't think they're going to telegraph between now and then a rate hike of 0.25%. So all in all, it was a good report, but there were some really portions of the report that indicate growth is going to slow in the weeks and months ahead. I expect that, higher inflationary pressures. But until then, until we meet again on the first business day of April, may your economic cup runneth over.